Hey, Dennis.
Hi, Paul.
Hey, hey. All right. Are you, I guess you need to stay on, huh?
Yeah.
Okay. Um, Perfect. I just wanted just double check sharing. I just sent you a request to share.
Yeah. Can you share it now?
Okay. All right. You see the
Mm-hmm. All good.
presentation now? Okay.
Yep.
All right. Perfect. And while I'm sharing this, can you, um, I've got my little video screen here to show like my picture and image. You don't see that on the screen.
Yeah, I can.
You see this that I'm moving around right now? You see that?
Mm, I only see, look at the trailing financials.
Yeah, but you don't see me in my in like my little video of me moving that around. I just wanted
Mm,
to double check you if you see that or not.
no.
Okay, okay. Perfect. Okay. Stop share. Perfect. All right. I just wanted to double check to make sure that was working okay. Ooh.
Mm-hmm.
Um, and yeah, should we just leave this on? I guess as far as the recording, um, do you turn the recording off and turn it back on?
If the recording is on.
Okay.
Yeah,
But
anyway, I will
but
just
if
edit.
you'll just edit it?
Yeah. I'll just
Okay.
remove this one. Oh.
Okay. Um, my battery is on my computer's dying.
Hmm.
Shoot. Okay. Well, I might need to make some adjustments here. I'll just mute myself and I'll come back on in a little bit.
Okay.
Still there, Dennis?
Yep.
Okay. Just double checking. Yeah, I think I got everything ready to go. So, um, yeah, I'll I have a few more things to run through, and then I should be good to go.
Yep. Okay.
Hey, Dennis,
Yep. Well,
can you so you can see the presentation on the screen now?
yeah, yeah.
Okay. Hi, welcome everybody. We'll get started here in a few minutes. We'll just it's not quite 4 o'clock Pacific time yet, but we'll get started shortly. Welcome everybody. Yeah, we'll just get started here in just a few minutes. Allow everybody else to follow in. Um, we our chat has been disabled, but you could go ahead and use the Q&A for any questions that you may have. Go ahead and use that now if you have any questions and want to get started. But we'll get started here in just a few minutes. Thanks. All right. Welcome everybody. Just a few more, give it one more minute here before we get going. Seeing some familiar names coming in, so welcome everybody. And as just a reminder, our chat has been disabled, but feel free to use the Q&A for any questions that you may have. I'll do my best to answer them live here on the webinar. All right, we'll go ahead and get rolling here. So Thanks everybody for joining this webinar tonight on how to underwrite a multifamily deal in 10 minutes. So I got a few slides to go through here, and if you wait till the end, there is a gift for everybody that attended today's webinar. So let's get going. All right, let me just hide here. Okay, so why underwriting matters. So what is underwriting? Underwriting is the process of making forward-looking statements or projections to assess a property's future performance and viability. So a forward-looking projection is also called a pro forma. So you may have heard multiple terms, so either pro forma or projection. So in a nutshell, underwriting is making educated guesses about the future performance of a property. So underwriting, for multifamily investing, it isn't gambling, and underwriting is a tool that we use to keep ourselves safe. You need to create a fast filter when you're looking at a lot of deals, so that you could zero in on the winners and trash the losers there. So the tips that I'm going to teach you tonight could save you hours or even weeks by spending just a few minutes up front, so that you could quickly filter all your deals that come into your inbox. So we do this very actively on a daily basis here at CPI. And this is just one of the tools in our tool belt that we use to evaluate multifamily deals and other development deals. So who am I? My name is Paul Hopkins, and I'm the VP of Investments here at CPI Capital. My background is construction engineering, focusing in on bridge projects. Being a project manager, I've worked on major project estimates. So taking an estimate, which is basically the forward-looking projection of how much it's going to cost to build this bridge or this project, and then actually taking that estimate and going and managing that project. And so it's, a lot of the skills that I've learned through engineering and project management translate a lot into underwriting and multifamily investing. I've been investing in multifamily since 2015, and I've been involved in 6 full cycle deals with multifamily focus that have been 100 plus units, taking it all the way from acquisitions to a successful exit. So it does say put in the chat who here has experience in underwriting. But since our chat is disabled, go ahead and use the Q&A as far as who might have some experience. I'd like to see at least if anybody has an experience in here. Don't be shy. Go ahead and throw it in there. Please let me know. I want to see. But for those that don't have any experience in underwriting, um, if you stay throughout the whole presentation, you'll get a glimpse into CPI's underwriting model, and actually get access to that. And as a bonus, using artificial intelligence, I will also provide you with a link that we use to quickly evaluate deals. It's a chat GPT that I created to help us evaluate deals quicker. So I'm just going to look here in the Q&A. Yeah, Andrew has some experience in underwriting. Tony has some experience. Brock, you do. Jan, you have, but it's been a while. All right, so a couple people answered. Thank you for participating in the Q&A here. All right, so underwriting models. There are many helpful underwriting models that are Excel based. There's also Argus. There's other software that you could buy that can help you analyze multifamily deals, development deals. There's a slew of them that are out there, and the larger the property, it can get very complex. So there are some really detailed underwriting models, and there's some very basic underwriting models, but um, so underwriting, just keep this in mind. Underwriting is a bit of an art form, and it's not an exact science. So, but the skills that I'm going to teach you tonight is just to quickly evaluate a deal. I do have other webinars that I've done in the past, and we'll do more in the future here about how to do a deeper dive into underwriting and analysis, but this is just very high level. Um, Underwriting models, basically, they all do the same job, but they provide outputs in different ways, and the inputs can also be slightly different. But um, with the different underwriting models that are out there, you can have the same input, and then some of them, they'll provide different output depending on how it's structured, and the details behind it. So just wanted to throw that out there that not all models are exactly the same. They might provide some different results. But do you need a fancy underwriting model to basically analyze all the properties? And no, you don't. So it's certainly helpful. In a pinch, you should be able to roughly underwrite a deal using a calculator, a pen, and a piece of paper in 10 minutes or less. And with the AI tool that I'm going to be providing you, you could do it in just a matter of seconds. So the 10-minute underwriting framework. So first we're going to check the rent rolls, and then we're going to estimate the market rents. Then we're going to look at trailing financials, apply a quick expense ratio. Then we're going to roll into forecasting the net operating income, how to calculate that, choosing a cap rate, and then calculating that value of the property based on that input. And then finally, we're going to look at comparing the price versus the value. Um, then looking at the overall debt coverage ratio. And then the next step, what are we going to do? Are we going to dig deeper into this property, or are we going to pass and go on to the next deal? So I'm going to break each one of these down on the following slides here. So first step, we want to check the rent roll. So you're going to check the rent roll, and when you're looking at the rent roll, you want to start to verify a few key things. You want to look at the units and the unit mix. That includes, the number of beds and baths, and you want to look at what the current rents are for each of those unit types. So while you're looking through the rent roll, you want to look for any obvious red flags. So are there too many vacant units? Are there rents that are way below market or sometimes even way above market? Um, or does it have an unusual kind of tenant mix? And that's a little bit more of a deeper dive when you look into the different types of tenant mix. But what is a good unit mix? So, for example, let's say there are two identical 100 unit properties, except for the unit mix. So, property A has 100% one bedroom units, and property B has an even mix of one, two, and three bedroom units. So, just like which one? Put it in the chat, sorry, the Q&A. Which property do you think has greater stability? Would it be property A or property B? Anybody? Anybody? B, B. Yep. Yep, the answer is B in my opinion, because it's offers great diversity throughout the unit mix. We have looked at properties that have been like strictly all one bedroom units, and honestly, we passed on it because you want to have a little bit of a unit mix variation to accommodate all the different types of demand. Some people prefer two bedrooms, some people prefer one bedroom. If you have a couple, they may want a third for an office space. So, it gives people options, and you're able to keep the occupancy higher if you have a good, healthy unit mix. All right, so step two, you want to estimate the market rents. And sometimes on rent rolls, the rent rolls do include a market rent, but the market rent on rent rolls is, think of it as arbitrary, that it's an arbitrary rent that is established by the property manager as a goal for them to achieve the rent. So if they say that, for example, if you have a comparable two-bedroom units that are in the area that are renting between 1650 and 1700, the property manager may set the bar as the market rent of 1,700 when the rents are maybe at 1,500. So that $200 difference is like the goal for the property manager to take that current rent to the market rent. Okay. Market rents they may be different than the actual rent charged, and that is completely normal. So when you're looking deeper into the T12 and the rent roll, you just want to make sure that these all these items kind of line up and match with each other. So when you're looking at to at least verify, so the market rent, when you're trying to determine what the market rent might be, or verifying what is on the rent roll as the market rent, you could look at the rent roll. You also want to go through CoStar and look up apartments.com and also speak to other brokers. Hey, what is the two-bedroom in this market typically renting for? What would be that market rent? Oh, I've just been told that chat is now enabled, so you guys can should be able to use chat now instead of the Q&A. So when you're looking at your rents versus a market rent, if the market rent in the area is greater than your current rents, then you know that there's some potential upside. If your rent roll current rents are above the market rent, that's a red flag. That's just basically saying that there is no upside potential, that it might be hard to continue leasing the units at that rate that you have. And the value might be coming down. So that's another red flag that you want to pay attention to. I'm just going to check the Q&A here just to make sure that there's no other questions. Okay, perfect. So I'm just going to say that answered. Perfect. Okay. So with step one and two, what you want to do now is check, like I was saying before, checking the rent roll with the market rents and put them side by side so that you could actually see the comparisons between the two. So what I do is I take the rent roll in Excel format and I actually break it down into the different floor plan types. And I usually take it a little bit step further and say, okay, there are 20 unrenovated one-bedroom units, and I'm going to categorize them as a certain type of floor type. And there are 10 renovated units, and I'm going to assign them a different floor type. And the reason I do that is so that I can see what the in-place rents are on the unrenovated and the in-place rents are on the renovated. So, for example, this bedroom, one bedroom, one bath unit, its in-place rents is $1,227, where the one bedroom, one bath, simply modern, that's what SM stands for, it's receiving a little bit higher of a rent because it has been renovated. So from 1227 to 1250. And you can see on the right-hand side, the market rents, what the property or those units could be renting for. The one bedroom at in place of 1227 is slightly higher than market. So that's a little bit of a red flag that you want to pay attention to. However, the renovated unit, so if I was to renovate the one bedroom classic unit into a simply modern style, I could either achieve the in-place rents of 1250 or the market of 1265. So there's still some upside to the renovation and this specific property. So if you look down at the bottom, the in-place actuals total average 1376 versus 1449. That's just saying that there's room to grow, there's potential upside. Great. I'm going to move on to the rest of my analysis with this property. So now we're going to look at the trailing financials. So you want to ask for a T12, which is the trailing 12-month profit and loss statement from the property and the property manager. So what you're going to focus on initially is looking at the gross income. your operating expenses and your net operating income. So just doing a quick sanity check. Are your expenses too low for this property or this asset class in this market? Is the income stable? Is it, if you look over the months, each month, are you seeing stable income coming in each month? Is it growing? Is it decreasing? Does the rent roll match the income? So that's another check that you want to look at. So the T12, the final month on the T12 should match the gross potential rent from the rent roll. Look for any trends one way or the other in the income and expenses. Is the income growing or decreasing? Are expenses increasing or decreasing? Are there any large reoccurring operating expenses? And that's a good thing to pay attention to because sometimes operators will put their capital expenditures, so like the improvements to the property, they'll put that in their operating expenses, which will skew the T12 and not be truly representative of how this property is actually performing. So you want to remove those items from the T12 if they are CapEx items. Looking at the concessions, any concessions or vacancies that are on the T12, making sure that they are accurate and reflected based on what you typically would see in this market. So when looking at the trailing financials, so this is an example of T12 from an actual property that we had under contract. And so the box that you see here on the left shows what the T12 gross potential or operating revenue is. And I also show the T3, which is the trailing last 3 months. So the box on the left is the operating revenue, and the box on the right is your operating expenses. And I've broken it down into two columns, the T12 and the T3. And the reason I do that is so you could compare, is there actual growth? So if there's been improvements over the last 3 months and you annualize that out, how does that compare to the T12 for the income, the net operating income? So if you look, for example, on these two examples, down at the bottom left, the effective gross income under the T12 was 2.4 million. But if you look at the T3 annualized, it's 2.4 million. So it's pretty stable. There hasn't been a whole lot of growth happening as far as the income. But then when you look at the expenses, the total expenses under the T12 was 1.4 million versus 1.5 under the T3 annualized. So that just shows you something is going wrong, or didn't, maybe not wrong, but you want to know what's happening at least with that uh, the last 3 months. Like, why are the last 3 months expenses? But that's a question that you want to write down, and then you explore that further when you basically pass the 10-minute test. So these are just some of the flags that you want to pay attention to, make note of, and then move on. You don't need to analyze it too much deeply yet, but these are the things that you want to start to look for. So when also looking at the trailing financials, you want to look at your total economic loss. So is the economic loss reasonable for this property and in this market? Again, looking at basically the T12 versus the T3, you could see that the total economic loss across the T12 was about 3.7%. But for the T3 annualized, it's 6.5. So, it's a larger increase on that. So that's another red flag that you just need to pay attention to when you do a deeper dive. Or these are simply questions that you could start asking the broker about. So the next step after you've reviewed the income and expenses, you want to look at basically the expense ratio. So actually, one trick that you could use is when you're as far as just doing a quick analysis on a property is just to apply an expense ratio instead of if you don't know the expenses or what the expenses should be, or if the expenses on the T12 don't make a lot of sense, you could just simply apply an expense ratio for what that property should see in that market. So first, you determine the effective gross income, and then you determine what the expenses are based on the expense ratio. And a quick rule of thumb, the expense ratio should be between 45% and 55% of the gross income. So, for example, from a T12, if I have an effective gross income of 2.4 million and my and I should be seeing around a 55% expense ratio, then you take the EGI times the expense ratio and you'll have $1.3 million in expenses. So if you have understated expenses in your underwriting, if you're assuming that the expenses are actually lower than what they are, that can be very dangerous and you can be buying yourself a bad deal. The higher expense ratio that you use, you're staying more conservative. So I recommend in the beginning when you're looking at this to use a higher expense ratio, and then you might be able to trim that down as you dive a little bit deeper into that property. So when you apply an expense ratio. So, for example, on the T12 that I keep sharing here, you could see on the right-hand side on the bottom what the actual expense ratio is for that particular property for the T12 and the T3. And you could see that it's on the higher end. Their expenses are at 59% for the T12 and 65% for the T3. This is maybe not a red flag, but it's an opportunity. It's an opportunity that tells me, hey, like these guys are spending way too much money on expenses and they're out of control. This is an opportunity for us to buy this property and improve the expenses, bring down that operating expense ratio, which will increase your net operating income. So that's the next step is to determine what the net operating income is. So you're going to look at your gross income minus your expenses to determine what your NOI is. So from example, on that T12, the effective gross income was 2.4 million. Our expenses at the expense ratio of basically 59% was 1.3 million. So our NOI is uh, basically 1.1 million. So that's important. You need to get to that NOI point. So now it's time to pick a cap rate. Now, uh, this is your best educated guess on determining what the market cap rate is. Now, how to determine that is you consult with basically your different brokers like CBRE, other broker firms, CoStar, and just do that type of research. Ask those questions to the different brokers and do your research. So the higher the cap rate, you're going to get a lower purchase price. The lower the cap rate, it should be receiving a higher price. So, for example, if you have a market cap, it's going to be about a 6%. So the graph on the right-hand side is from CoStar. This just shows currently where we're at based on CoStar, what the United States is. And so that kind of like teal line there for the United States, 2025, showing it is approximately a 6% cap rate for the market. Now, each market is going to be unique and different. You should know what that cap rate is for that specific market. But this is just the overall United States. So the next step is you want to calculate the value. So quick valuation, the value is the net operating income divided by cap rate. So for the example that I've been using for an NOI of just about 1.1 million with a cap rate of 6, to determine the valuation, 1.1 or 1.092 million divided by 6%, you're going to get a valuation of 18 million. So just as a side note, this particular property that I'm talking about, we purchased it for 16.8 million. So we were, after all this, we were able to actually get a pretty good deal based on, I guess, the overall market cap rate for this example. So bonus slide. I'm going to give you guys a bonus. So who here has heard of the 1% rule? Go ahead and throw it in the chat if you have heard of this. But basically the 1% rule is a quick gut check for multifamily deals. And this also applies to single family deals as well. But the average in-place monthly rent per unit should be at least 1% of the purchase price per unit. So this helps. This is another way for us to quickly identify overpriced deals or properties that have low rents. The 1% rule is a quick screen. It's not a replacement for underwriting, but it's just a quick guide. There could be many quality properties in strong markets that fall far below this 1% rule, but it may be a solid investment with appreciation and growth rent potential. So, for example, average in place, the same property that I've been using in this webinar. The average in place rents, if you recall, we're at 1337. So if we divide that by 1%, we're going to get 133,000 per unit. So if you multiply that by the number of units, which in this case was 136, so 133,000 per unit times 136 units, 18.1 million. And you recall, based on the cap rate of 6%, what the valuation of this property was? It was about 18% or 18 million. So it gets you right in that ballpark. So now you've got your basically your valuation, and you're going to now start to compare your value to the price of what the seller is asking for. So if the seller wants 20 million and your estimate is coming in at 18.2, it's not a deal breaker. It's time to start negotiating this deal with the broker and the seller. So another thing that you do want to check is your overall debt coverage ratio. So your annual debt service should be less than the net operating income divided by 1.25. 1.25 is basically the minimum debt coverage ratio that you want to be using when looking at properties. And so you can calculate the annual debt service, talking to a lender, and they can give you what that expected debt service would be for that particular property. So for this example, if you have a annual debt service of the NOI of 1 million over 1.2, your annual debt service is around 873. As long as that 873 isn't any greater, you're good. So principal and interest should not, and the other way to check this is your principal and interest should not exceed around 80% of your NOI. So again, your NOI being just about 1.1 million times 80% is 873. So that's another way to check it. So for this example, about 1.1 million in NOI, I was given basically the annual debt service by our lender. So taking the NOI divided by 550, it's a coverage of 1.9%. So really good coverage. I'm way over that 1.25 minimum coverage ratio. So I'm good on my coverage with NOI and debt. You just want to make sure that you have enough net operating income to pay your debt and then still have enough cash flow available, obviously for paying your investors or make sure that you're not going to be in default if you have any issues with the property and you need that extra cash infusion for any reason. So now it's time to decide. Are you going to dig deeper or are you going to pass? So, we talked about some of the red flags, some of the opportunities that you look at when you're looking at the rent roll and the T12. Is there upside? You should be able to kind of see that if there is upside, if the current rents are below the market rents. Is the price close enough? Or is 18 million versus 20 million, is that close enough to have a conversation? Are there any other red flags? Like one red flag that I showed was the operating expense ratio on this particular property for the trailing 3 month average was 65%. Maybe not so much a red flag, but more of an opportunity. And now this is a point where you just say, okay, it's time to dig in deeper. Or if you got too many red flags and there's just, not enough meat on the bone, pass and move on. So let's walk through together here with everybody on the call a very super simple example. So let's assume that we have 100 units where the average rent is $1,000 per month. And you got a 95 occupancy, meaning that you have basically a 5% economic loss. And your expenses are about 45%, that's the 45% expense ratio. And we're going to use a market cap of 5.5%. And the asking price is 12 million. So I'll give you guys, just a minute here to kind of calculate it, see what, based on this information here, what is your valuation for this property and compare it to the asking price. So I'll give you a minute, see if you guys can throw it here in the chat. So 100 units. I'll start walking through you what this with you in a second, but got 100 units, $1,000 average rent per month, 95% expense ratio, or sorry, 95% occupancy, 45% expense ratio. All right, Brock comes up with value of 12 million based on NOI, 55,000 K monthly. Okay. Anybody else? Anybody else calculate that? Yeah, okay. 10 million. All right, here, I'll show you my example. So with the gross potential rent of 100 units times $1,000 a month times 12 months, you're going to get a gross potential rent of 1.2 million. You're going to apply your occupancy of 95%. So you're going to get an effective gross income of 1.1 million. Now you're going to calculate your expenses. So using an expense ratio of 45%, 1.1 times 45%, you're going to get an expenses of 513,000. And then you want to calculate your NOI, which is your effective gross income minus your expenses. So it's 1.1 minus the 513, $627,000 is your NOI divided by the cap rate of 5.5. You're going to come up with a value of 11.4. So you're fairly close to the asking price of 12 million. So time to discuss this with the broker and determine if you want to apply the next steps. Yep. Brock, you forgot the effective loss. All good. But that's why we always double check each other as well. So perfect. Everybody got that and understand. Hopefully it's just that's a quick way, less than 10 minutes to kind of evaluate a deal. So next steps here. A bonus slide. Here we go. So for us and what we're seeing a difference between the bid and ask spread. So why deals aren't always lining up on price. So recently at CPI, we're seeing a gap between what the seller's expectations are and what their asking price is and what our underwriting model shows. Even from the time we do it, the back of the napkin kind of math and underwriting to doing a deep dive, we're usually coming up between 80 to 85% of the seller's guidance or asking price. So I just wanted to throw that out there to everybody. Like, even if you're coming up to like 80% of the seller's asking price, it doesn't mean that the deal is dead. It's just a starting point for negotiations. And like, we are right in line with our competition when it comes to that. So like every time I submit a letter of intent based on our underwriting, I call up the broker. I'll walk through the underwriting with the broker. And in most cases, we're right in line with the rest of the competition. There's some other obviously some levers that we can pull to increase our offer or make our offer juicier. But that's where you start to negotiate with the broker and seeing how you could actually get this deal with the seller. So we still submit an offer, even if we're at like 80 to 85% of the seller's asking price. Um, you know, it the reason that we do that is so that we're showing our commitment to the broker. We're also showing our commitment to the sellers. And the sellers, they actually want to see that type of feedback. They're getting actual market feedback for what the true value of their property is. Um, and sometimes the deals will close somewhere in between the initial ask and our overall underwriting. But you can also get creative, like I was saying, like there's seller financing, earnouts, or you could, other find ways to bridge that gap in other ways. So it's not always the done deal. So when you're looking at, for an example, $10 million ask and your underwriting comes in at 8 million, it's an 80% bid ask spread. So, we're typically landing, like I said, anywhere between 80 and 85%. And we're still submitting offers even at that price. So takeaways that I want everybody to have here. So the bid ask spread is always normal in today's market, and don't walk away too early. Deals happen somewhere in the middle. Uh, Underwriting, it doesn't need to be complicated math. I just went through this example with you guys on how to basically quickly evaluate a deal. And you can do this work in 10 minutes. It'll save you a lot of time up front and a lot of headaches. This is what we do for every deal that comes in. We just quickly evaluate it, come up with the value that we would have, and ask the broker what the asking price is, and see how we compare, talk to the broker about it, and determine the next steps. If the deal looks good, yeah, dig deeper, tour the asset, and then run the full underwriting model. So I'm going to stop here and answer any questions that you guys might have. And I also, and thanks for sticking around. But I also wanted to provide everybody here on the call with access to CPI's back of the envelope analyzer. It's an Excel model that I've built, and I also have instructional step-by-step videos on how to take the rent roll, upload it into the back of the envelope analyzer, taking the T12, uploading it, so that you could do it in two ways. You could there's a little bit deeper dive into doing it, or similarly how I explained on the webinar today, a quick and easy way to basically do an analysis based on, just some simple information. Before I let you guys go, I'm going to come back to this. I'm going to stop share real quick. And I want to show, since artificial intelligence is, it's getting better every day. I want to show everybody another tool that we are using here at CPI, and I'm going to be also giving you the link to this. I'll put the link in the chat here. But if you guys can see this, so I built this GPT within ChatGPT. And I call it the CPI Capital Multifamily OM Analyzer. So when you get an offering memorandum from a broker, and the broker, when you see these offering memorandums, and I'll just open this up for example. I should have done that ahead of time. So when you see these offering memorandums, let me stop share, and I'll just use this as an example once it loads. So the offering memorandum that you get from a broker, it's a marketing material. It has a lot of information about the market, about the property, lots of pretty pictures, lots of graphs, lots of tables and charts. And it could be very time consuming to go through an OM from a broker, especially when you're looking at lots of deals like we do every week. you want to you want to basically weed through these OMs very quickly. Um, and here we go. It's starting to load up. Um, so if I just share my screen here. So this is an offering memorandum for a deal that's currently on market. I think call for offers is tomorrow, actually, on this deal. So this is a 112 unit property in Jacksonville, Florida. And if we, just quickly scroll through this OM, it's a big one. That's why it takes a while here. You can see, just some information about the occupancy, the year it was built, what market it's in, current rents. So this is the current in-place rents on that property. Um, lots of other details about, type of construction, the tax details, utilities. And so, it can take a while to actually comb through all this, gather all the information that you need. You got details on the unit mix and so on, right? This is a typical offering memorandum. So what I've built, the exciting thing about this is I've built a GPT. Open this up again. All right, give it a second for you guys to see. So I've already uploaded the OM into this GPT. I'm not going to say anything else, but basically just hit enter and let it do its thing. So excellent. So this just took a matter of seconds just now. And I'll jump down to the punchline here in a second. But based on the offering memorandum for Morningside Apartments, here's the OM summary. So it breaks it down into usable information step by step. So it gives me the property name, the address, the number of units, lot size, number of buildings, details about the construction, it's concrete block. Um, the roof type, HVAC, uh, details about the utilities, details about all the amenities, interior upgrade opportunities highlighted are right here. And then I've created it to give me basically like the overall business plan. What's the investment thesis? What's the business plan? It is a value add opportunity. Um, it's some of the details, operational improvements, similar to what I chatted about earlier, implementing utility reimbursements, so like RUBS, charging tenants for trash, pet control, renters insurance, enhancing laundry income. There is no assumable debt, value add opportunities, how to improve all the units. Here's a breakdown of the unit summary. So like the number of units, the current in-place rents of 954, the pro forma rent. The pro forma rent based on the offering memorandum is $1,000. So there is some upside potential on this. Um, and then I ask it to give me all the rent comps, and based on what the asking rent is and the rent per square foot, gives me an operating expense breakdown. What are we spending in place per unit per month? Total expenses around 6,200 per unit per year, not per month. Um, and this is a good metric that I'd like to use as well. Like, we should be seeing somewhere between, um, say, 8,000 and 9,500 for a property around this size. So their expenses are quite low. So that would be kind of a red flag for me to look at. Um, and then details on the property tax. And then here's a summary of the deal. So Morningside Apartments is 112 unit, built in 1973, located in Jacksonville, concrete block construction, new roofs in 2024. Current rents are significantly below market. And then here, this is the kicker right here. So market evaluation based on the in-place NOI and at a 5 cap, which is probably a little too low for Jacksonville right now. But based on a 5 cap and the in-place NOI, I should be our value should be around 14, 15 million. Based on the pro forma NOI, and looking at the pro forma based on that and the valuation of say a $10 million purchase price, cap rate of 8.1. Um, so yeah, this is a great tool that we use to quickly evaluate deals. Being, like we're already like the chat GPT has already found the NOI and calculated the cap rate, or sorry, calculated the value based on the cap rate that I have in here. But I will give you guys also this link to this GPT. So I've copied the link, and I'm going to throw this here in the chat for everybody. So you could use this right now, and and start uploading offering memorandums into this GPT and coming up with the valuation. And I could just say, what if the cap rate for this market is say 7%? What is the value? So if you're not good at math and you forget how to do it, this GPT will do it all for you. So it's just saying, based on the NOI and the cap rate is 7, it's going to give you a valuation of a 10.6. So I'll put the QR code back up on the screen for everybody so that you can take a picture of that. And you can download our back of the envelope analyzer. I'm making some improvements, just so everybody knows. I'm making a few improvements and tweaks to it right now. So by sending your information to this link, you will be getting access to that updated back of the envelope when I'm done with it, and then you'll get it right away. You'll have that within the week. So with that, I will, that's the end of my presentation. So hopefully everybody here learned something or taken something away. And if anything, you got access to my GPT and the back of the envelope analyzer. So with that, I will ask any questions that may have come up during the webinar. So please ask away if you have any, or type in the chat here. Just I'm not seeing the link to the GPT. Oh, 1 second. Sorry about that. My battery was dying on my computer, so I had to take a step back here. Oh, okay. It looks like Ava was able to put the GPT back in there. So excellent. Uh, just checking the Q&A here. As for that. Um, Yeah, perfect. Sorry. Uh, if anybody had any questions, now that I'm back, I could throw that back up on the screen here for the QR code for everybody. But please do ask any questions that you may have while I'm here. And I don't see the previous questions if there were any, so I apologize for that. So if you re-enter it in, thank you, Joseph. What was the Whisper property on the Jack's property? I think it was actually at 12, no, I think it was about 14 million. So somewhere around there. I'll have to double check that. I don't remember off the top of my head. Share this. There we go. Perfect. Yep. So you got your QR code back up on here. Okay. Any other questions that I missed? Apologize again that yeah, my computer died right at the very end. I thought it was plugged in, but apparently it wasn't. So at least I got all the way through it there to the end. Yeah, if anybody doesn't have any other questions, then we'll go ahead and you saw questions. I don't see any questions because I just logged in. So if you had a question, please type it back in. Oh, no questions that you saw. Okay, thanks, August. Great. Well, I'll end it here. Again, here's our contact info, the QR code. Once you scan that, you'll get access to us anyways, and you'll get access to our GPT and back of the envelope analyzer. So, thanks for staying with me. Sorry for the last minute technical difficulties, but appreciate you all, and have a great night.